Okay, so welcome once again. This is Management Decision and Control, and today we want to learn more about cost management and strategic management accounting. Okay, like indicated, this is one of the topics that we need to cover, especially when it comes to MBC. It's more theoretical in nature, so you basically listen through. You must have these notes just in case you don't have. Can be able to request for them after this class. Okay, so of course, why do we study cost management accounting? The reason why we studied this is because there has been a lot of trend in the way cost management has changed, strategic management accounting has changed. It's no longer about variable costs, fixed costs, find the cost, the total cost of the product and price it, and that is all. Okay. When we are saying cost management, ours is knowing that every organization is towards ensuring that we are reducing our costs as much as possible. But then the reduction of costs should not affect the service that we're offering to the customers, okay, with our cost management. Similar to strategic management goes beyond to just look at the perspective of us looking at our internal systems or internal production, but us going beyond to look at things like the competitors' products, look at the market trends, look at how demand is applying, and so on. Okay, so that is what we basically want to cover in this area. So it's very good that you understand, of course, the limitations of the traditional management accounting control systems and what exactly cost management brings. Now, one of the things you need to know, and why this topic also was the fact that, of course, we used to have the traditional management accounting control system, which is basically comparing results with the preset standards, partly what we covered when we are trying to look at the standard variance analysis as well as budgeting. Okay, so we are saying that cost management should not just be about us working with the status quo, like we've drawn a budget and then we want to analyze between the budget and then the actuals to think that we actually have the right way of managing up our costs. So with of course, with cost management, we are saying we should not be about cost containment. Okay, by cost containment means we are maintaining the status quo of the budgets that we set at the period, but rather we should focus on cost reduction. Okay, everyday cost reduction, but the cost reduction should also be not to affect the service or the quality of the products that we are offering to our customers. Okay, yeah, so we have just a few criticisms of the conventional management accounting, of course, which now drives us to the strategic management accounting and the cost management that we are doing. The conventional management accounting, of course, does not take into consideration the changes that are happening currently in the manufacturing environment. Okay, things like changes in the market, changes in the manufacturing environment, changes in production management. For it basically focuses on things like financial reports, allocating costs based on volume. At the end of the day, also focuses on past information. Okay, so that is why we are criticizing the conventional cost management system. Okay, now one of the other things that also need to know with the conventional management accounting, basically what has been done in the previous, we have been basically focusing on the financial aspect. Okay, we consider only the financial aspect, so we don't bring in the perspective of the critical non-financial competitive variables. Okay, and of course with the non-competitive financial variables, things like customer satisfaction, things like innovation, things like improvement in processes need also to be taken into consideration when we are looking at I think it was the balance scorecard. When we are trying to look at I think performance measurement, we spoke of how the balance scorecard comes in to give us a picture of both the financial and then the non-financial performance measures as well. So the conventional management accounting, what basically has been done, conventional or traditional management accounting system, basically does not go into things like non-financial, okay? So it's very important that now the strategic management accounting and the cost management goes ahead to actually look at also these other variables like quality. Of course, quality, when you speak of quality, this is so much to do with the satisfaction of our customers, okay, as well. Things like lead time, flexibility, and so on. And also things like innovation. I think innovation comes on also right here under the aspect of flexibility, okay? Yeah. The other that you may also need to take consideration is the traditional product costing system also provides misleading information for decision making. And the basis for this assertion is around of how the traditional costing system allocates its costs, okay? Remember when we are trying to look at the ABC versus the traditional, we saw that when we are using the traditional, we allocate costs, let's say, based on machine hours or labor hours, or we could also allocate this based on volume, okay? So it means that if you have two products, maybe you have, I'll give you an example. Maybe you have Minute Maid and then maybe Coca-Cola within your production premises. Now, for it to look at what is the quantity of the Minute Maid, maybe cartons vis-a-vis the quantity of the Coca-Cola, maybe crates or boxes. At the end of the day, these two products are totally different, and you cannot basically allocate, for example, the overheads, the fixed costs, based on just volume. You have to go in detail to understand what are some of the activities that are taken to produce some of these products. And that's where ABC comes in, okay? So the traditional product costing system, one of its limitation is that it's because the way it allocates some of the costs, okay, is a bit improper and gives us misleading information. And that's why this misleading information may also lead us to wrongly price our products, which in reality means that we are pushing out a product in the market that is wrongly priced, means that we are going to face competition. And at the end of the day, of course, it's going to sabotage our growth as a company, okay? So that is one of the limitations. And all these limitations, like indicated, are the limitations that brought up the strategic management accounting, okay? And then, of course, the other one, the traditional management accounting, also relatively gives little attention to the external environment. Basically, for it costs, their eyes on, we've drawn this budget. At the end of the period, we have our actuals, and they compare the actuals with the budget, okay? That is basically what exactly they do with the traditional. So the strategic management accounting comes in to now look at the wider view, okay? And that's why we are bringing now the strategic management accounting here, which we are saying that this provides an analysis of the financial information on the products market, the competitors' costs, the cost structures, and monitors the enterprise's strategies, okay? Besides those of its competitors in the market over a period, a number of period or a period of time. And that is the whole aspect. That's all that they are doing there is the strategic management accounting process, okay? So it's very important. And all this comes in, like indicated, it's coming in because of the limitations of the traditional, okay? So this comes in as to change the narrative, okay? Yeah, so it's very important. So basically, as you can see, strategic management accounting, its intention is to determine the products, economics and costs. It determines and monitors the firm's strategies and cost structures. Just from the definition here, it goes ahead to determine and monitor competitors' strategies and cost structure. Like you see, it goes beyond the internal, just the internal environment, but goes ahead to even look at aspects of the competitor strategies and cost structure, and then does a response strategically. By response strategically means that if we are planning to produce maybe a given product and we compare this with how maybe the products of the competitor are going, or the trend of the products is going, then that can easily advise us on what trend we should also be taking. Okay, so it's very important. I guess an example, if you're maybe you're working with, let's say, Airtel Uganda, and then we also have MTN Uganda, and maybe we are looking at this product called Airtel Money, okay, or mobile money in general. Now yours is to say you're not just looking at this, the way your mobile money is working as Airtel, but yours is also to cross over and see how is MTN reinventing itself every day to make sure that their product is better. And based on that, then we are also able to respond strategically. If we see that MTN is taking a direction of, let's say, bringing up things like maybe loans, mobile loans, then we also need to take the same direction. And that's why you see it's like a cutthroat kind of competition for some of these organizations, because they keep a strategic eye on each other to make sure that they are not just producing something within, just utilizing their own structures, but they're also basing on the knowledge of what is exactly happening outside. Okay, so that is very important when it comes to that aspect. Okay, now also understanding when it comes, of course, when it comes to strategic management accounting, like we said, it looks at the market prospects of the existing products. Okay, and then it goes ahead to also look at their position in the product life cycle, and then the portfolio of the products. Now, by life cycle, I think we know the product life cycle, that we start from the introduction, and then we go to the growth, and then we go to the maturity, and when we go to the decline. So as we are looking at maybe the cost of the product, okay, ours is saying that we are not just looking at the product as it's as the way we see it, but we are also looking at what stage is this product, and also understanding what are some of the costs that we should expect for this product at a given point in time. I'll give you an example that right now, if it's, for example, the mobile money product, the organization must be planning ahead, because they know that this product, let's say, has reached maturity. At one point in time, it may find itself in a decline. So they have to prepare ahead to see how will they manage some of the costs. And that's why you see when we are going to look at the life cycle costing methodology, for it, it looks at the overall life of the product, and it's able to spread the respective costs that are across the whole life of the product within, to embed it within the how much we are selling this product. Okay, and why this is also very important is because when this product reaches decline, you're going to incur more costs, but you're not going to increase its price. Okay, because already people are finding alternative to it, but then you still need to sell it at the same price, okay, to be able to still retain a given market, as now you rebrand. Okay, now all this has to be covered within your strategic management accounting process to make sure that you're not just looking at a product, but you're also looking at its future, looking at where it lies. When we say portfolio of products, means that we are also looking at what are some of your other products you have. So in case like for MTN, ours to say we have the mobile money product, we have the data product, we have maybe the calls, okay? We have the messages. So ours to see how is this product within the portfolio of the rest, the other different products, okay? So that is what strategic management is basically trying to do. So as you can see, it involves us taking, of course, external information that is relevant to the firm's products market. It goes ahead to also use external information, especially the strategies of the competitors, their cost structures, internal business. Goes ahead to evaluate and report on the firm's strategies, as well as monitoring. It goes ahead to also report on the success factors, okay? In terms of cost, quality, time reduction, and continuous improvement, as well as innovation, okay? Yeah, so that is very key. So just for us to also, like I indicated, when it comes to cost management focuses on cost reduction. Remember, our topic is cost management as strategic management accounting. So as we understand in the strategic management accounting, it's also good for us to appreciate what exactly is cost management, okay? So we are saying that cost management focuses on key things. It focuses on cost reduction. It goes on to also focus on continuous improvement and change rather than cost containment. The word cost containment means basically going with the norm, with the status quo, like going with the costs that you've set at the start of the period, okay? So we're saying that cost management does not look at that aspect. Rather, it looks at cost reduction every day, okay? Yeah, so it's very important that we understand. So cost management is preferred for the different reasons here, of course, because we are definitely, like we said, it's continuous cost reduction, which is definitely good for the company. And one of the other things also we need to understand when it comes, of course, with the cost reduction, there's also continuous improvement as well with the cost management. We are not just remaining the same, okay? And then one of the other things also, we are saying that also many of the approaches that are incorporated within the area of cost management do not necessarily involve the use of the accounting techniques. So basically, here, we don't need so much the accounting techniques, okay? Because remember, we are cascading down to even other qualitative things like continuous improvement, change rather than cost containment. So we are not on things like standard variance analysis, okay? That are going into comparing what we had in the previous, maybe with the current, or what we had in the budget with what we have in the actual, okay? So that is very important when it comes to cost management. So in general, cost management does what? Seeks to reduce costs, okay? We are also saying that it should not be at the expense of customer satisfaction, like I indicated. As we do all whatever we are doing, ours should make sure that we are not compromising on the customer satisfaction, okay? Yeah, so that's very important. And then we have the target costing, okay? We have the target costing. And with the target costing, what is here is that you know the price, okay? You know what is the price. So you make a market research of what is the price. And with the target costing means you're doing this at a design stage. For example, I'll give you an example. If today, let's say, if I'm working with, let's say, Coca-Cola, and we want to introduce maybe a new drink, okay? It could be a juice drink, okay? In addition to maybe to our to the Minute Maid. So here, what we are saying is, we are going to say maybe we want to do a product like the way you used to see there are these juices that are made in boxes, okay, instead of bottles, but we use boxes. I think we've seen them with I think different companies, okay? I think like Britannia had one. So we may want to take that direction of our production of juice, okay? And ours is to first ask ourselves, how much price can we sell this product, okay? How much can we sell this product in the market? And once we have understood how much we sell this product in the market, and that is based on the demand, based on the other competitors' products, and based on, let's say, market trends. So once we have understood how much we can sell this product, we now do what? We now determine how much do we want to make on this product, okay? So that is, the other is the first step, determining the price. The next one is how much do we actually want to make of this product. So if, for example, we want to make, let's say, if the price is, let's say, maybe 5,000, okay? And we want to make a margin of 20%. And 20% of the 5,000 is about 1,000, okay? So we have removed the margin. So the remainder is what we call our target cost. Okay, so the 4,000 would definitely be our target cost. So what target costing does as a process, like we are seeing here, it involves setting of a target cost, which is gotten by deducting a desired profit margin from a competitive market price. That is basically what we do. So what we shall also understand that when we do that process, ideally, what is on the ground may totally be different. We may actually find ourselves that we have a target cost at 4,000, but in reality, we are incurring how much? We are say incurring, let's say maybe 6,000, okay? Maybe 6,000. So if we are incurring more than what our target cost is, what we're saying here is that we should take necessary effort to continuously reduce this current cost to meet the target cost. Okay, so that is what target costing also goes to do. So it does not just end on just the deducting, but we also proceed to do that. Okay, so for it is done at the stage level, and of course why it is preferred is because you're able to look at the market even before you produce your product. Okay, so by the time you produce your product, you actually already you've already determined the price. So it means that you will not have issues with competition because you've already forecasted your competition. I think we know about the full costing method. Okay, which full costing method goes ahead to look at your variable cost, your fixed costs, and then adds a margin and then gives you the price. Okay, now here we are saying that we should not take that direction. We should rather do what? We should look at what is in the market, okay, and deduct what is our preferred profit margin, and then go ahead to have our target cost. So the organization should work all around to make sure that we are producing within our target cost. Now, target costing is part of our strategic management accounting process, okay, and it is also part of our cost and cost management. That's why we are seeing it coming here at this point in time, because we are seeing that it's getting away from just the internal structures, but rather going into the external side to look at what is the actual price in the market, okay? And that's why we are calling it the competitive market price, okay? So it is very important that we understand it. So we are going to look at other models of strategic management accounting, but this is one of them, okay? Which is called the target costing, okay? So that is basically the principle. So the examiners, as I think has said this before, where they ask you the steps, okay? The steps of setting a target cost. So we have write them here, okay? Like we said, we all start with what? With going into the market, where we do market research and establish the target price, okay? Now, you find now two cases. There are cases where you're introducing a product that already exists, okay? Where you already have maybe substitutes to your product. But there are also cases where you're getting into the market and this is your first time to produce this product, and this product has never been in the market before, okay? So that is why establishing the target price also goes ahead to also look at the aspect of customer perceived value, okay? So it's not about only the competitors' products, but if we are introducing a new product, mine is to say, for example, I'm coming up with a new innovation, okay, of let's say maybe a new smartphone, okay, a new smartphone that someone does not have to press with their fingers, but maybe can just speak to and say, call this person, or do this for me, or do this for me, okay? So you need to understand what would the customer feel comfortable paying for, okay? And then also looking at also the perspective of the closest substitute, okay? If the customer does not use such a product, what can they exactly use, okay? And how much would that product basically cost them, okay? And then the other is to deduct the targeted profit margin, like we said. After we've established this, ours deduct the targeted profit margin. Like I said, the target price can be like 5,000. your profit margin can be like say 20%, okay, which is 1,000. 20% of 5,000 is 1,000. Then you're able to determine the actual cost, which will be 4,000, okay. The 1,000 minus removed from the 5,000, and then next you'll be able to compare the two. And we are saying that if the estimated actual cost is greater than the target cost, then we should devise all means of doing what? Of cutting down costs so that they are within the target limit, okay. So that is what this so-called target costing does, okay. So it's very important that you understand the dynamics, and that is basically what you need to understand, especially when it comes to this aspect of target costing, okay. So we'll just proceed. So you can try to read more. These are basically just more guiding notes to help you understand more. But before we proceed with that, I just want to highlight something here. When it comes to this aspect, it's actually okay. When it comes to target costing, there's what we call the team approach, okay. And by team approach means that it's not a one-man's decision or one-man's process, but we should have all these people involved, okay. The designers, the engineers, the purchasing, manufacturing, marketing, and maybe accounting personnel, okay. And all those they are needed to provide guidance to the overall process, okay. Because purchasing definitely will give you the, let's say, the value of the raw materials that are used. Manufacturing will also give you a picture of how much of what exactly maybe is used within the process, okay. Marketing will give you the perspective of how much price really the customer can accept. Management and accounting personnel will also give you other maybe other costs, okay, that the purchasing, manufacturing may easily pick out. And then the designers, engineers will also be able to tell you what exactly is needed in getting this product out, okay. So that is very key when it comes to the target costing approach, okay. And one of the other things also we need to understand, just in terms of the major advantage of this target costing, okay, is that this is deployed at the product design level, okay, at the planning stage. Like we've seen before we even produce, we are already setting what would be our price, okay, what is our target price, as well as getting down to what would have been our target cost. So we are saying that it is advantageous in that way compared to the standard costing method, where we have to first determine the cost, or we have to first get into production and then determine the cost, okay. Yeah, so we need to know. One of the things they are saying is the lock-in costs, okay. Of course, the target costing, adopting it means that it is deployed during the product design and planning stage, so that it can have a maximum impact on determining the level of the locked-in costs, okay. So these locked-in costs, basically, they are costs that have not yet been incurred, but will be incurred in the future. So when we do the whole targeting process, we are able to even reflect on some of these costs that we are not yet aware, or we've not yet incurred, okay. It's basically what we are trying to mean here, okay. Yeah. So, and like we've indicated that after the process, we should compare the actual, the estimated actual with the target cost. So target costing also helps us to make a key decision that if we feel that our target cost cannot be attained, then it is telling us that it's better we actually even don't, let's say, produce this product, okay. So that is what we are trying to mean here. So it's very important that you understand. So ours is to say that when we are having this whole process, okay, the design team should be allowed to achieve target cost by eliminating desirable product functions. Remember, the target costing is a cost reduction approach, okay? Is a cost reduction approach. everything that we are doing is to make sure that we reduce this cost so that we fit within our required margin. Okay, so that's why we're bringing the aspect of the design team. Now, the design team has different concepts that it might use in this process, and one of it is the reverse engineering. Okay, the other is the value chain analysis. Okay, and then the other is called the process improvement. Okay, now these reverse engineering, value analysis, and process improvements are also key components of the strategic management approach. But for matters of target costing, we shall just try to understand what they basically what concepts they are. Okay, so reverse engineering itself, reverse engineering is also called, it's called the tear down analysis. Okay, reverse engineering is also called the tear down analysis. Basically here, what we do is we are examining the competitor's product. Okay, we are basically examining the competitor's product, and by examining the competitor's product, we are basically dismantling it to identify its functionality and design, and to provide insights about the processes that can be used to that are used, and then also understanding the cost to make the product. Okay, basically reverse engineering, what that will help us is if we are also planning our product. Okay, if we are planning our product, when we break down the competitor's product, we're able to find out, of course, the advantage that the other product brings, but also be able to identify any inefficiencies that may actually be within this product. And from that perspective, we can actually be able to not repeat the same mistakes that this other person or other competitor might have really done. Okay, so it's good for us to have that in mind. Okay, now very similar to that is the value analysis. Okay, which is also called the value engineering. Now, value analysis, or sometimes they call it value chain analysis, this one is a systematic interdisciplinary examination of factors that affect the cost of the product or service. Okay, in order to devise means of achieving the specified purpose at the required standard of quality and reliability at the target cost. Okay, now what value analysis does, if you're to compare it with reverse engineering, for it is more internally focused. Okay, for reverse engineering, we are trying to look at the product of the competitor, but for value analysis, we are trying to examine the product itself. Okay, and that's why we are saying that the aim of value analysis is basically to achieve the assigned target cost. So it goes ahead to identify, of course, the product designs that are improved and therefore reduce product costs. It also goes ahead to support to remove any unnecessary functions, okay, that may basically increase the product's cost, but are not in any way maybe, let's say, necessity to customers. And by that means that the customer may not be ready to pay an extra amount for them. Okay, so that is what that's the way you can basically distinguish between the two. So value analysis is internally focused, reverse engineering is externally focused, and it's more about the external the competitor's product, trying to make a reflection with our internal processes and seeing what are we able to benchmark. Okay, so value analysis is, for us, we are trying to improve what exactly we are doing with our product. Okay, yeah, so that's why they are saying the value analysis requires us to use the function analysis. Okay, and function analysis, like you're seeing, it's a decomposing. Here we decompose the product into its main attributes. Okay, and here the some of these could be the comfort, the reliability, the quality, the attractiveness, and so on. Okay, so that is what happens with the value analysis. You may be able to read the rest of the things. One of the other things that I want to comment about is the process improvement. Like we've seen, we say that when we are achieving the designers are trying to make sure that we achieve the target costing, we look at three things: the reverse engineering, which is also called the tear down analysis, and then the value analysis, and then the process improvement. So we've understood the other two. Ours is also to understand this. So process improvement, of course, from just the word process, as value analysis and engineering for it focuses on the product design. Process improvement is about the process, okay, about the business process, the day-to-day operations, okay. So we are able to look at the day-to-day operations and see if we have any processes that can help us reduce our costs, okay. Yeah, so we're able to study our processes and say, if this is mobile money, maybe a customer has to first visit the service center and then maybe be able to withdraw their money. So we have to have different service centers. And I was like to say, can't we have retailers who are able to do this work across the different value chain? Okay, and then we're able to make such a choice. Okay, and then things like how are we able to pay? For example, I'll give you an example. If MTN previously, at the end of the month, maybe it would bank money for its operators, the mobile money operators, maybe on their bank accounts, okay? And it would have a process within there, even somebody who handles this whole process. These days, you're able to track your commission on every transaction, and on a given date, this commission they have tracked, the system will just change it and deposit it back to your account, okay? So that is what basically will happen. So it's good that you understand these dynamics, okay? So I believe you can understand those three. So target costing, as you can see, its focus, it's price-led, it's customers. Price-led means first looks at the price outside. It looks at the customers. Remember, we first go into the market to determine what is the customer perceived value. And then we are doing this at the design stage. We're not waiting for the product at a point in time when it is already in the market, okay? We also, we are saying that with target costing, we also have a faster time to market because we've already had the perspective of the market and we've gone ahead to design a product that basically suits the market, okay? So just a comparison between standard costing and target costing. I believe you now have an understanding of standard costing when we're trying to look at standard costing and variance analysis, where we say that standard costing involves setting targets, okay, on which we basically targets for unit costs, basically on which we measure ourselves routinely. So target costing, in comparison, as we can see, when it comes to target costing, we are doing this at the design stage. We're not waiting for the other point in time when we are actually now in the normal production, okay? So that's why we are saying that this is actually at the point of the production introduction process. Well, the standard costing will be routinely, it will be throughout the product life cycle, okay? Yeah. So that's just a comparison of the two and to help you also understand. One of the other thing is also to comment about is the learning curve and the target costing, okay? Now, also when we're trying to do, when we are trying to do, I think this was around cost estimation. There's one of the topics is cost estimation that we did. The cost estimation, one of the models that we looked at was the learning curve, okay? And with the learning curve, we say that this theory says that labor is more productive with time, okay? Basically, the cumulative time that labor takes to complete its unit product, okay, changes every time the number of units double, okay? So what we are saying here that the learning curve also has a relationship with target costing, but it's only applicable so much when we have a labor-intensive environment. Now, you know the learning curve, if you have you at least watched the class of cost estimation, You know that learning curve operates with labor, okay? Learning curve is a labor theory, okay? It's basically, it benchmarks on labor being experienced every time it does. Basically, we're saying that the time you take to produce the first unit is way higher compared to the time you take with producing the second and the next unit, then the other unit. Basically, the theory says that labor keeps on improving in its productivity, okay? Yeah, so how these two are compared, we are saying that learning curve may be a major part of target costing. Remember, the labor cost is part of the target cost, okay? But then it depends on the nature of the manufacturing process. If it's a machine intensive, then we don't expect a lot of impact, okay? Compared to when we have what? A labor intensive environment, okay? Compared to where we have a labor intensive environment. Now, when you have a labor intensive environment, it means that the learning curve will apply. And so it means that our target cost, okay, will definitely continue to lower, okay, as we continue to proceed through the process, okay? Yeah. So that is what you may understand when it comes to that. The other that we're also comparing with the target costing is the Kaizen costing. Kaizen costing is one of those models also under strategic management costing system. And Kaizen, basically the principle is that Kaizen believes, it's a Japan model that believes in continuous small improvements, okay? Continuous small improvements that are backed up by the employee involvement, okay? Small improvements, small continuous improvements that are backed up by employee involvement. And why we're saying employee involvement? Because it believes, the theory believes that employees better understand some of these costs, okay? So in comparison of the two, the Kaizen and target costing, okay, what we are saying is that the Kaizen, for it looks at, the word Kaizen is improvement. For it looks at continuous striving to improve, okay? However, you know that target costing is at the start, okay? Target costing is actually at the start of the production process. It's not after, it's not later on, okay? So that one you should be able to know, okay? Yeah. So with Kaizen, just so you know, it's also another part that we shall just look at maybe differently, but just so you know that Kaizen has a continuous circle. This is basically its process. It is plan, do, check, and act. And by plan, what we are trying to mean is plan the different ways of how you expect to, let's say, improve on your process, okay? Basically, you're setting a target for improvement, okay? And then the other do is now the implementation of your plan. Check is comparison of between your plan, okay? And then with determining whether you've actually achieved the plan. Then the other is act, okay? Act means now standardizing. If at all you've achieved, if the check has given you a confirmation that whatever you planned has improved, now continue with that. Standardize the improved procedure going forward, okay? So that is very important. So in terms of differences, like we've said, target costing is before production commences. Kaizen is throughout once production has started, okay? And target costing more looks at significant changes. Kaizen is about small improvements, okay? Kaizen is about small improvements, okay? Yeah. So most of this that we are looking at, basically the examiner can just bring you maybe a relationship between Kaizen and target costing. So able to give, let's say, a similarity, and then you're able to give a distinction between the two, okay? And the other thing is, of course, being able to give examples, by the way, okay? Like the way I've been using MTN, using Coca-Cola, be able to bring all out these concepts, even when you're not able to remember the actual words. But if you understand the concept and know that if somebody asks me about Kaizen, all I need to know is that Kaizen speaks about small continuous improvements, and also understanding that Kaizen involves employee involvement. Okay, so we shall try to continue to study that as we see. So target costing in service industry, of course, target costing in service industry is a bit complex. Okay, is a bit complex because of the ethics of services. Okay, and I think you must have come across these ethics of services, things like intangibility. Basically, you cannot go with the service. For example, what we are studying right here, you cannot say, I've been able to get this component, I've been able to take away this knowledge. Okay, it's basically intangible. Okay, the other one is the inseparability. Basically, if at all we are looking at you consuming the service from me, okay, we are saying that no service exists until it's being experienced or consumed by the other person. Okay, basically, I cannot just pick the knowledge and give it to you. You must actually, you must have presence for you to experience the service. Okay, and then the other is the verifiability or heterogeneity, and with this means that there is no standardization. The way I'm running this class may not be the way I've run this class before, okay? Because there are different dynamics. We are studying at different times and different perspectives, okay? So that happens with the service. Then other is the perishability, that these services, in most cases, they perish immediately, okay? They perish immediately. After this class, the service is done, okay? It's not like a product that you go with. And then the transfer of ownership, the same thing also happens. Services, we cannot transfer property, okay? So based on that, these are just some of the services. So based on that, us determining a target cost and also determining the customer perspective and how much the customer may be able to pay this may be a bit expensive and complex compared if it was a product business, okay? So that is why it's very important that we understand how those could actually play. So we are saying that when it comes, of course, to services, okay, a service is business requires a need of both quantitative and qualitative information to price its services properly, okay? Remember, target costing starts with a key step, which is called the pricing, okay? So we are saying that we need to make sure that there's need to control the total costs that of providing the service, provide the cash flow, need for operating information to identify how costs were incurred, and so on. Okay, so we have those difficulties as indicated here. The difficult to precise definition of some of the services. Okay, and that means that of course, basically defining the service itself is a bit technical. It's also a bit difficult to decide on the correct target cost, okay? Because we may not know what may exactly be entailed. It's not like mixing sugar, wheat, flour, and blue band together, and then you can determine the cost. This one is now a service, okay? You don't know how long labor will take to actually offer service thing. Basically, the service is determined by other factors that are external that you cannot predetermine easily, okay? Yeah, and of course, it would also basically be hard to determine, especially when it comes to when you're determining the price, okay? So, especially for new services, where you may have a difficult in getting comparable data. Basically, data in the field, it's a service, it's a new service that has never been offered. So you cannot easily even determine what would be the appropriate price to work backwards to determine your margin and determine your target cost, okay? Yeah. So the other aspect is target costing does not only end at the aspect of us determining the target cost and then comparing between the target cost and the estimated actual cost. There are also steps that we can use to reduce the gap between what? Between the target cost and the actual estimated cost, okay? So what some of those processes could be, of course, to reduce on the number of components, like we reduced maybe the functions, reduce which we can use cheaper stuff, okay, to get a lower labor cost. We can use standard components wherever possible instead of having tailored, okay. Then we can also acquire more efficient technologies, okay, training staff in more efficient techniques, cutting out non-value added activities. By non-value added activities, these are usually things that they basically don't add value. They are presumed to have an impact in the production, but they basically don't add value, okay? And that's why you see some organizations, instead of doing some services, they adopt what we call the outsourcing, okay? Instead of having a full department that is doing accounting, they would rather invite an accounting firm that only just maybe looks at their financials once in a month, and then they have they have what? They have already estimates that they need to work with, okay? So that's important to understand. And then also being able to, of course, to use different materials. Instead of, let's say, using maybe polythene, you may use paper bags, okay? Find a cheaper way to do it, okay, to meet your target costing, like that. So that is what I can say about target costing. There is a lot of information here about the implication of target costing. Ideally, I believe that right now you understand this. So once you look at the notes, you'll be able to so we also have benefits here, okay? So you now know that once we do this, target costing focuses on the external force to its product development, because it starts with an outward looking approach, okay? And then we also have only features that add value to the customer. Remember, we say that anything that does not add value to the customer, we remove to make sure that we are cutting our costs, okay? Control costs will begin much earlier in the process. Remember, we start at the design stage, which is much easier than us launching and then trying to cut costs, okay? So we're able to manage costs at the earlier stage, okay? And then cost units are often lower under target costing environment, because definitely we do push. It's a whole process of cutting and reducing the gap. So at the end of the day, our cost is really small, okay, to help us be able to get our desired margin. So they can ask you about the benefits there. So you may just need to read more and understand how most of them are. Of course, we have adverse effects, basically disadvantages also. The product development stage may take a little longer time because it's a forth and back. There's usually numerous changes. We have a lot of employee pressure because there are targets in place. So employees are on pressure to achieve the targets, okay? Especially the margin target, okay? Or the target cost in its own. And then also organization conflicts. And this might happen especially at a time of when you're designing the product, okay? So that is one of the other things that you may need to look at. So you can try to read more information to help you, okay? So one of the other next thing that I want us to look at or concentrate on is the benchmarking, okay? Is the benchmarking. And with benchmarking, what we are saying here is you're basically comparing yourself with the competitor, okay? You're basically comparing yourself with the competitor. And what this means is if you're comparing yourself with the competitor, you want to make sure that you're not doing something that is maybe costly when the competitor is actually incurring a lower cost, okay? So with that in mind, just a moment. Okay, so that is what benchmarking does. does for you. So it, from definition, it basically refers to a mechanism for achieving continuous improvement by measuring products or services against those of the best performing organizations. Okay, so as you can see, it's a continuous improvement process. Okay, it's basically continuous. Now we have different types of benchmarking. We have what we call competitive benchmarking. Okay, we have what we call competitive benchmarking, and with competitive benchmarking, basically we want to compete. Okay, and this is where we do a search of what the other person is doing to make sure that we are finding a best way to also produce the same thing and compete with them. Okay, and then we also have what we call the generic function operational benchmarking. Now, this may not be competitive. It may be even across different industries. For example, if we want to benchmark on how we treat our employees during the time of COVID, we might benchmark between MTN and Stanbic. Okay, basically, how is Stanbic responding to this time of COVID? And then also compare that with, let's say, MTN. And then we have, of course, the internal benchmarking. Now, benchmarking is not only outside looking that we look at other organizations. Benchmarking may also be internal. And by internal means that we can also look at the departments and see that we have one of the department that is performing, maybe staff are more motivated than our department. The other could be branches, by the way. If you're running, for example, a company that's in terms of branches, you could be able to benchmark from one branch to the other, okay? Yeah, so we also have a benchmarking process, just like the way we had for target costing. As you can see, ours first establish the objectives and determine the areas of benchmark. What exactly do you want to benchmark? Do you want to benchmark the process? Are you benchmarking the production process? Are you benchmarking the marketing? What exactly are doing the marketing, and so on. And then also you need to also look at the performance measures, because at the end of the day, you want to compare something with your internal. So you want to make sure that you're establishing the key performance measures. Then also you select organization study. If this is an internal benchmarking process, you definitely also choose the department that you're going to study, okay? And then you also measure your own and other performance, and then you're able to compare the performance. So as you can see, benchmarking is not just look, copy and paste, okay? It's basically it's a matching, basically comparing with what you have and what this other person has, okay? Yeah, so that's very important for you. And then we are also saying that after comparison, we should design and implement the improvement program, okay? And after that, we then do what? We then monitor improvements. That is what we do with the benchmarking process. So benchmarking has its advantages. As you can see, it's flexible, okay? It can be used by private and public, okay? By people have different responsibilities. There are also cross comparisons, like we have seen when it comes to branches and internally, which can help us expose radically different ways of doing things much better. It's an effective way of implementing change, okay? It also identifies the process to change, delivers services to a defined standard. If it's we're an organization and we are comparing how different branches are working, we can even come up with a system where we're saying that since branch A takes maybe 5 minutes to serve its customers, we should adopt that across the different branches, okay? So that is what happens. So we have also limitations to it. Of course, you cannot just copy somebody's way of doing things, especially for external people, organizations that we are benchmarking. It's difficult in accessing some of the information. We also may have difficulties in deciding which activities to benchmark, by the way, okay? Because you cannot benchmark everything. Difficulties in identifying the best in class of each activity. You may also fail to find whom really to benchmark with, okay? Because remember, the benchmarking process says you must benchmark yourself with the best, okay? And of course, the identifying may also be because you can't tell the production processes. This is like confidential information for some of the organizations, okay? Yeah. So persuading, of course, other organizations to allow you is also, of course, if you're a competitor and you want to benchmark with us, it's also another story, okay? And then successful practices in one organization may not be applicable. MTN may be offering maybe internet to its staff who are working from home, and you Stanbic wants to benchmark the same approach. Yet the other is a telecom company, maybe they can afford that. And for you, you're in your own other capacity, okay? So that is one of the things that you may look at here. Okay, so internally, of course, these are the internal comparison challenges what we may find. As you can see, amount of resources devoted to each units may differ. Like different branches, you cannot compare an Arua branch with a Kampala branch because of the different client base they serve, the different quantity of number of people they serve, and so on. Okay, and then also local differences as well, and so on. There's also possibility of manipulation of figures, okay? Especially when people know that they are being benchmarked, they can also do the same thing, okay? So we also have information for benchmarking right there, as you can see, the product information, the financial information, process information, and so on. So critical benchmarking issues are also highlighted there. I'll just try to run away from those so that we're able to cover something different, but you can take some time to read more of the notes and you'll be able to understand, as long as you understand the gist of what exactly you're studying, okay? So we have now the business process re-engineering, okay? Remember, we just looked at something called reverse engineering, or which is the tear down analysis when it came to the target costing. So we also have the business process re-engineering, and this is also a component of the strategic management cost systems. Okay, so business process re-engineering, as you can see, it basically involves what? It involves the examining of business processes, okay? We basically examine the business processes and make substantial changes, okay, to how the organization currently operates. It's basically, some people, I think, okay, this may not be called restructuring, but as you can see, we just look at what exactly are we doing, okay? And we're able to change it, to just overturn it and able to change everything that we are doing, okay? So that is what happens with the business process re-engineering. So we are able to look at the different processes, okay? Like for example, there's an example here of material handling. And in the material handling, we might have these respective things, maybe scheduling production, storing materials, processing purchase orders, inspecting materials, and paying suppliers, okay? So we may do a process engineering that may eliminate some of these things. Like for example, maybe it may eliminate maybe aspect of, let's say, storing materials, where we are maybe applying a GIT, where materials only come in when they are needed for production. So we don't need to have an aspect of, let's say, storing them, okay? Yeah, so you based on how you're operating and based on how the dynamics of your business, you can be able to understand. For example, inspecting of materials, instead of inspecting materials, you might agree that maybe these materials are actually maybe inspected from the point of contracting the supplier. You basically agree on these terms at the point of time of contracting. So you're able to agree on the actual quality dynamics, okay, that should come through, okay, from your supplier. So as we can see now, this is how the above activities can be re-engineered, okay? For example, they are saying the process might be re-engineering by saying the production schedule direct to the nominated suppliers. So instead of us having this production schedule confined to us, we may send this to our preferred suppliers so that they are aware of when we shall need the goods, okay? Yeah, and this may also come to us entering into contractual agreements with some of them to make sure that they're delivering the materials that are in accordance with our production schedule, but they also, these should also be of quality, okay? So that is an example of how a business process re-engineering can actually happen, okay? So as you can see, it also has different X-sticks, which we have listed here, okay? So you'll be able to take some time to read these through, okay? As well as we also, of course, it has principles basically to achieve its success, okay? As you can see, processes are designed to achieve desired outcome rather than focusing on an existing task. Remember, we are trying to look at the existing task and we are revamping it to determine how best can we actually handle this process. And all this is towards cutting costs, but also making sure that it's not compromising on the quality of the product that we are issuing to our customers, okay? Yeah. So you can read these principles so you know what exactly to need. There's also an example here of a business re-engineering where you're moving from a traditional functional layout to a JIT product layout. I think you know what a JIT means. Just in time. It's one of those key strategic philosophies that work with the strategic cost management system, okay? Yeah. So we go ahead to also give you how to implement the BPR, the business process re-engineering project, okay? As you can see, basically we start with the mission statement. We basically start internally. What is the purpose of the organization, okay? And what sets us from the different other players in the industry. Then we go ahead to things like producing the vision statements, which define the organization, where the organization is going, and providing a clear picture of the desired future position. Now, we want to make sure that we are not restructuring, laying off staff, changing ABCD, but it conflicts with our mission or with our vision where we are going. That is why it's very key that you start with, what is my direction? Where do I want to go? Okay, because that needs to give you direction, even if, because where you want to go, you're going to compare it with what? With what exactly is happening in the organization. And then that should be able to give you the direction. Because if your direction is to become the top #1, let's say, telecom company in East Africa, you need to make sure that your processes are also driving in the same direction. That's why we take that direction, okay? So the others build these into clear business strategies, thereby deriving the project objectives. And then we define behaviors that will enable us achieve our aims, okay? And then we are also to produce the key performance measures to drive the process or to track the process. And then we relate efficiency improvements to the culture of the organization, okay? And then lastly, identify initiatives that will improve performance. So basically, that is what we basically do when we are trying to look at aspects of business process re-engineering, okay? So you'll be able to read more so that you conceptualize that. The other is Kaizen. Kaizen is also one of those part of what we just basically want to know. I already explained more about Kaizen, okay? Where we say that Kaizen is about small continuous improvements with the involvement of staff, okay? It's basically a system of cost reduction that looks at continuous review of systems and procedures to identify and implement small incremental cost savings. These are keywords. The small incremental cost saving is a keyword when it comes to here. And also the continuous aspect. It's basically a continuous process, okay? Review process of our systems and procedures to identify those key aspects that can help us save costs, okay? Yeah. And like I said, this system also works with what? Works with employees' empowerment and employees' involvement, okay? And like I said, why we involve the employees? Because they best understand the whole process, okay? They best understand how we basically run, okay? So that is very important when it comes to Kaizen. So Kaizen costing, as you can see, it's a Japanese model, as earlier indicated. For us, we already did this comparison of Kaizen and target costing, where we say that yes, both of them are towards improvement, but one of it, target, looks at a significant cost reduction. Kaizen, for it, it's more of small continuous improvements, okay, that will happen. So that is so this is just to help you with more reading about the Kaizen approach, okay? So they can also ask you how organizations can use the Kaizen approach to improve on their costs, okay? There is also a comparison here between standard costing and Kaizen. It's just so you understand the two things. Once you understand both of them, you're able to easily compare. Remember, standard costing, for it, it's about setting targets and measuring itself on what we have achieved, okay? Basically the variance analysis approach. Now, Kaizen says that we should not base on our focus should not be on the target that we set, okay? Like, if, for example, I'll give you an example. If you have maybe a repair cost of your vehicle, if you set that your budget is 2 million every month, okay, with standard costing, you find yourself that even when the vehicle is not really ready to go to the garage, because you already have that budget of 2 million, yours is to make sure that at the end of the month, you're not underspending, okay, on that budget. If, for example, you're working for organizations like government, okay, so you're going to just find yourself, even extent where it's a small patch, you're going to a garage and you're going to incur a lot of money, okay? Now, that is what standard costing, the direction that standard costing takes us to. But Kaizen says that, why should we actually repair this vehicle this early? Can't we wait to the quarter, to the end of the quarter, and then repair it? Because for it, it's on any small improvement in the cost reduction, okay, is key when it comes to the Kaizen concept. So yours is to understand how these two things work, okay? Then you can able to make a constructive judgment between the two concepts, okay? So that is what exactly happens with the two, okay? So that is Kaizen. So the next one that I also want to comment on is just in time. I already spoke about just in time. Now, the just in time philosophy is also a philosophy from Japan, and it was brought up to reduce on the stock holding costs, okay? It was brought up to reduce on the stock holding costs. And what I mean by stock holding costs here means that the just-in-time philosophy does not believe that we buy stock, okay? We buy raw materials, keep them, and we keep removing from them to take to the production process. Just-in-time, from the word just-in-time, says buy inventory when you only need it. Buy raw materials when you already have a customer who is waiting for the final product. And immediately the product is done through the process, the customer should be able to take the product, or the organization should be able to do the delivery to this respective customer, okay? So that is what just-in-time, the principle or the philosophy basically does, okay? So it reduces on, of course, wastage by us producing what is not required, okay? And also, it also reduces on aspects of the time that we may take between ordering and then receiving, okay? Because for it is just in time, okay? It is just in time. As you can see, it's a demand pool manufacturing system. you basically start from the demand perspective. You don't push. It's not a push thing. The push system says get raw materials, manufacture them into finished products, and put this product out to the market. Just in time, we are saying go the other side, look at the customer, okay, and then come back and get the respective materials that will serve the customer, okay, and make sure that you're going to serve the customer within the required time, okay. That is what the philosophy does. So just in time has its own features, as you can see right there. The rearrangement of the production process. Remember, just in time is a component of the business process reengineering. It's one of the components, okay? So it could be a rearrangement of the production process into the production cell, consisting of the different types of equipment that may be needed to manufacture given products, okay? With the pull factor, okay? And then reducing on set times, okay? And by set times, we are meaning the amount of time required to adjust equipment settings and retool for production of a given product. GIT also emphasizes on total quality management. Total quality management is also one of the concepts of the strategic management cost control system, but it also works here, okay? And by total quality management system, we are saying that everyone in the organization is focused on improving quality, okay? From the gate man to the salesperson to the person who is in the production. It's not a production department business alone. Total quality management is the organization is all driving towards improvement of the quality of the product, okay? Yeah. So the GIT system, like we said, also the delivery of the materials should actually be immediately, as well as understanding that the delivery of the final product is also the same thing, okay? Yeah, definitely the management accounting systems would also be adjusted to fit the GIT production system, okay? Yeah. So we have the GIT purchasing, which is just part of the GIT process. GIT purchasing means that materials are immediately gotten from the supplier when they are needed for production, okay? So like we said, this is basically to reduce on having inventory. Basically, we are reducing inventory to the minimum, okay? And this means that this will reduce our stock costs, okay? So that is what happens with the GIT system, okay? And then we are also saying with the GIT system, of course, the GIT purchasing, of course, large quantity discounts, okay? Remember, with the GIT system, it means that we are ordering at a point in time when we already have, let's say, a customer who is interested in, okay? And it also helps us to do a lot of planning when it comes to the demand. So we can be able to enjoy discounts right there. We also have reduced ordering costs, okay? Because of the granted long-term orders, okay? And then we also have greater customer results that come into the high quality deliveries and greater product variety. Reason why we are bringing the high quality, the higher quantity deliveries and greater product variety. Remember, this is it's basically, we are saying it's a pull system. We basically look at the customer and then come and produce. So we're able to give the customer what they actually need, rather than producing something and wait to look and go and look for the customer who will buy these products, okay? Yeah. So goals of just-in-time system, basically for us to remove any value-adding activities. Basically, it's a zero inventory. We don't want to hold any inventory. The raw materials are brought in when we have already the production process started. At the end of the day, when we finish production, somebody should be taking these goods, okay? We also say that just in time also incorporates the total quality management, which says that do it first time right. Do it right first time, okay? There are also zero breakdowns. Remember, it is total quality management, as well as 100% on time delivery, okay? That is what it does. So we have the benefits here that we have already, part that we have looked at, just more to give you there. But as you can see, reduction in carrying costs, the store function is eliminated, loss of breakages, wastage, and so on. Material purchase controls is exercised, okay, and so on. So we have conditions that are effective. Examiner sometimes loves this question. The conditions that are necessary for effective working of the JIT system. Remember, we are saying that we should have inventory when we need it, and we should have the customer ready to take up our product, finished product. So we have conditions that can help us achieve that. And one of the conditions, we should have flexibility between what? Between suppliers and internal workforce. Basically, we shouldn't have cases where if we wake up and want a commodity from a supplier, the supplier says we cannot offer you in 2 days. Because for us, we want as much as we need it. If we need it within 2 days, we should actually have it in 2 days, because that's when our customers need it. Okay, yeah. Raw material inventory must be of guaranteed quality. Of course, remember we said JIT works hand in hand with TQM, total quality management. So we don't want to have returns in the process. If goods have been brought for production, they should be brought into production and should move systematically across the production process, okay? And then also we should have a good working relationship, of course, between suppliers, knowing that they can be able to do immediate deliveries as and when we need it, okay? So that is why you see for some companies, JIT system may not be applicable, because some of these suppliers are at a distance geographically, okay? There is no geographical proximity. So a time like during COVID, if you're using the JIT system where the airport has even been locked up, it means that you don't have any storage of some raw materials that can cover you during such a hard time, okay? So JIT has limitations, and the limitations actually come from here, okay? If you don't have flexible suppliers, it means you're limited. If there are issues to do with quality of the raw material inventory, it means that that is an issue, okay? So you should be able to, these are like assumptions, okay? But they can also be turned into limitations as well. Okay, of course, the workforce must be willing to increase on its working hours from one period to the other. Remember, workforce is not just producing. They must produce back on demand, okay? So there are times when workforce is going to work many hours. There are also cases where the workforce is going to work a few hours, okay? Yeah, so that's very important to know. And then the design of the factory must be such that the JIT deliveries to all areas are possible, okay, and so on. So we have disadvantages here, as we've seen the assumptions. Of course, the disadvantages are basically around the limitations we might have. For example, the reliability of the suppliers. Implementing this at its own is a hectic process, okay? It's basically a hectic process that you don't want to really go to, okay? Yeah. So we have these different other models like backflash costing. Backflash costing is not this one. If you have some time, you can be able to read. Just backflash costing is a simplified costing system that aims to eliminate detailed accounting transactions, okay? It's basically it is the accounting system that we apply when we are using the just-in-time production philosophy, okay? So this one I don't want to give more focus on to it. You can try to go through just for your understanding. It's also one of those recent ones. When you look at the course outline, it is not really brought up, but international, it's one of those strategic costing methodologies, okay? that you need to look at. The same thing also when it comes to the throughput accounting as well, okay? The throughput accounting. And of course, as you can see, it's sometimes called the OPT. This is based on the principles that profits are expanded by increasing the throughput. By throughput is the amount passing through a system from input to output over a period of time of a plant. You can read this. At least you have the notes. I just want to concentrate on what you may need to have more focus on. Okay. At least make sure at least you read more about the through output accounting. Okay. And like we said, this is also adopted. This is also part of the GIT philosophy. Okay, part of the GIT philosophy. And like we're saying, of course, assumes that resources are available. Okay, and this may comprise of buildings, capital equipment, labor, and this. So using these resources, purchased materials and parts must be processed to generate sales revenue. Okay. So that is all. But for GIT, basically what you should know about GIT, okay, like what we just, how to explain it and how does it work. You should know the benefits of GIT. You should also know the ethics of GIT. By ethics of GIT, I'm speaking about the conditions of GIT system. Then you should also know the limitation of GIT system, okay? Yeah. As well. Okay. Yeah. Okay. So allow me comment on T2M, because T2M is also a key part of the strategic. The others app that I've just left out are part of GIS just in time for your further reading. Okay. So T2M, everyone is towards quality improvement. It's basically describes a situation where all business functions, the word all business functions is very key. They are involved in the process of continuous quality improvement. Okay. It basically focuses on delivering products and services of consistently high quality in a timely fashion. Okay. In a timely fashion. That's why it's called total quality. No one is left out. Total quality management. Okay. Yeah. So we are saying that T2M has created fresh demands on the management accounting function to evaluate the quality of products and services and activities that produce them. Now, you know that there's quality and cost work parallel to each other. Okay, not okay. Having a quality product and having an optimal cost sometimes are parallel to each other. Like you cannot achieve an optimal cost if you want to have something of so good quality. Okay, for you to have quality, you have to go with a high input cost. Okay, so that is why it has brought about the fresh demands for the management accounting function to continue to measure, okay, and evaluate the quality of products and services. Okay. Yeah. So of course, like I indicated, these ones work hand in hand, okay, with just in time process. Okay. So when it comes to quality, okay, of course, quality, if you're defining quality, quality is just the degree of excellence of anything. Okay, basically how well it is made, how it is performed, but also, you know, quality is also from the perspective of the customer, because it's the quality of the product means that the product can actually meet the satisfaction of the customer. Okay, so that is very good to understand. So when it comes to we are calling it quality could also be in relation to the rival, or it can also be regards to each supplier. Okay, and here when we are regarding it to each supplier, there's what we call the vendor rating. okay? The vendor rating. Remember, the quality of the product is so much determined by what? By the quality of the raw material, okay? And that is why the vendor rating also comes in here, because at the end of the day, we want to make sure that even when we are sourcing for our raw materials, these are meet the required quality, okay? They basically meet the required quality. So T2M rotates around the following. So T2M inspects the output, basically what we have produced, to ensure that it meets our different control criteria, okay? So we're able to check and see if we are producing water, to make sure that the water is labeled rightly. There's no deformation of the water bottles, okay? They can open very well. Then we should also monitor the customer reaction, where we're able to get feedback from our customers, okay? And also look at the complaints that are coming in from our customers. And then the other one is also to look at our employees, okay? Basically the attitude of employees towards work, okay? And also knowing the kind of employees that we are bringing in, okay, as well. Because you know, if you bring in an experienced employee, it will increase on your level of quality, okay? Yeah, so that is it. Then we have the characteristics of the total quality management programs. Those could also be conditions, okay? As you can see, organizations must accept the organization way. In the whole organization, there should be acceptance, okay? That the only thing that matters is who? Is the customer, okay? Because the customer is who drives the decision when it comes to quality, okay? Then we should also recognize, okay? There should be recognition of all pervasive nature of customer supplier relationship, including our internal customers, okay? Which could be our employees or departments, interdepartments, maybe transactions, okay? For example, moving materials from one division to the other. And also, instead of relying on inspection, okay, we should also make sure that the cause of the effect is actually prevented, okay? So it's not about just inspecting the products, but we should make sure that whatever results we are getting from the inspection, that one is used to improve on our production, okay? So employees must be personally liable for any defects, okay? So it means that employees should also be responsible to produce quality products, okay? We should also move away from the acceptable quality levels, okay? Where we say that any level, or it's not about saying this bottle just has a small damage so it can pass. Total quality management is saying we should make sure that any defect is unacceptable. Remember, we are saying total quality management, okay? Yeah. So we also say that total quality management, all functions, so all departments should be obsessively trying to get things right the first time, okay? Yeah, so we should also have quality satisfaction programs. I think like the way we have UNBS, we have other international ISO, international satisfaction organizations. We have different, so we should be able to have those as an organization, okay? So we also have critical factors for the implementation of T2M, basically what should be in place to achieve T2M. We should first focus on the customer needs. Everyone in the organization should be involved. Remember, T2M is for all functions. Our focus should be on continuous improvement. T2M is not a one-day process, it's a continuous improvement, okay? Of course, the aim should be to design quality into the product, and not only the product, but also the whole process, the production process, okay? There should be support from top management in terms of driving the respective change for quality, okay? An effective performance measure system to be able to measure ourselves on whether we have achieved or not. So we should not only just have financial, but we should have things like non-financial, like customer perspective. We're able to send out feedback forms and hear from our customers, okay? Of course, rewards should exist. Basically, employees that produce quality products should be able to get a reward, not a discouragement, okay? Yeah, and continuous training and education so that everyone is aware of that. So we have the cost of quality. Like I said, quality and cost work in parallel to each other, okay? So we must make sure that we study the cost of quality, okay? So basically here, the cost of quality is the difference between the actual cost of producing, selling, and supporting a product, and the equivalent costs if there were no failures during the production or usage, okay? So the cost of quality can be looked at in terms of cost of conformance, okay? Making sure that the products conform to the standards. Then the others are prevention costs, okay? By prevention costs means that we are making sure that we are not getting to a defect position, okay? So prevention costs could include supervision, okay? Could include things like quality planning, investment in a good machine, training cost, and so on, okay? Anything that we are doing towards getting quality is a cost of quality, okay? Quality comes, achieving quality in an organization comes at a cost. So these are the dynamics, okay? Then the other is appraisal costs. As you can see, with appraisal, we are trying to basically evaluating, okay, our products, okay? And these are costs that are incurred to ensure that the materials, product, services meet the quality conformance, okay? So you have like an inspection team that does that. And then a cost of non-conformancy, just in case you don't conform, it's also a cost, okay? Remember, you're incurring a cost to achieve the quality, but also in case you don't actually achieve the quality, there are also costs attached. And those could be around internal failure costs, okay? For example, where you dispatch, there could be costs that, remember here, the internal failure costs are costs before we send the product to the customer, okay? Like, for example, you, instead of a water bottle has a deformation, you have to scrap it. That's a cost. Things like repair of the machine or repair of that vehicle that has come out as not okay, whatever it is. Things like work stoppage and so on. And then we have external failure costs as well, okay? And these costs could include things like maybe warranty, replacement. Now, external are when the product has gone outside, okay, to the customer. So as you can see, we just try to list them here, the prevention, the examples, okay? They are right here, as well as the appraisal costs and then the external failure costs as well. So you can try to read more about that. So T2M is an interesting part that you need to know, but basically yours is to, when it comes to T2M, you need to know how to explain the total quality management process, okay? You should also understand how to, the X-sticks of total quality management program, which we have looked at. You should also understand the costs of quality management, which we have seen, the preventional costs, okay? The cost, the appraisal costs, and so on. And then also, you should also understand the effects of course, total quality management over the organization, like the benefits, okay, that we might basically have. So you can take time to conceptualize on that, okay, and see how all that comes into play, okay? Yeah. So the quality control, quality assurance, okay, remember, these ones also form part of your T2M model, okay? And quality control is basically concerned by what? Concerned with maintaining quality standards, okay? Basically, I think you've seen, I think some organizations have quality control systems in place, okay? So these are usually procedures that basically look at the quality of the raw materials, the quality of the work in progress, and then the finished goods, okay? Yeah. And then quality assurance, this so much deals with a supplier, okay? And we're saying it is a term that is used where a supplier guarantees the quality of the goods supplied and allows the customer to customer access where the goods are being manufactured. Basically, you're trying to inform the customer that we are doing all it takes to produce the quality product for you, okay? So quality control is basically an internal, okay? But quality assurance is saying that we are doing all it takes. So even the customer can be able to access the whole process, okay? Yeah. So that is what happens with that. I also just want to comment on, I think at least we've done benchmarking, we've done business process reengineering, the just-in-time, the T2M. The other you may also want just to also understand is the life cycle costing. Remember what I said about life cycle costing? For you to understand the life cycle costing, is you need to understand the product life cycle, which starts from what? It basically starts from introduction, goes to growth, maturity, and decline. So life cycle costing for it says that we accumulate, okay, all costs for the entire product life cycle. For example, if you're introducing, let's say, a new drink in the market, ours is to also look at the product and development costs for that drink. Ours to go through and predict and see if we introduce this drink, what are some of the costs that we shall incur along its product life cycle, okay? And these costs could be, for example, at a point in time when we are introducing the product. Introducing the product means we are going to do a lot of marketing, a lot of research and development. When it comes to growth, okay, we also know that we are going to also do a lot of branding and marketing and creating awareness about the product. When it comes to maturity, we understand that, of course, maturity, because this product, we have to increase on our distribution costs and so on. Then at the decline stage, we have to include things like rebranding, okay? Because the product has reached a decline stage. Nearly the market, in the decline stage, you have already, the customers have alternative products, okay? So that means that ideally, if we don't rebrand, if we don't reinvent ourselves, there's likelihood that we may be pushed out of business, okay? So all those costs have to be looked at. So we are saying that the traditional cost system, for it, it's based on the accounting financial year. It basically just looks at the 12 months period, okay? Not the whole life cycle of the product, okay? So that's why life cycle costing is a key component of the strategic management control system, okay? Yeah. Yeah, so as you can see, it tracks, accumulates costs, actual costs and revenues attributable to a product across its entire product life cycle, okay? And it means that we can easily determine if a product is profitable or not, okay? Remember why it's very important for you to look at the entire product life cycle is that at the start, when you're producing this product, the research and development costs are going to be high, okay? Because you're going to hire consultants, you're going to do a lot of samples and so on. Now, if you price your product based on the cost that you've incurred, high likely that you'll not have a competitive price, okay? Because your price will be high. But if you spread this cost of what you had in terms of your, let's say, your introduction costs, research and development, and spread them across the life of the product, it means that even when you get to maturity stage, okay, where you have a high demand of the product, you're able to recoup part of the money that you incurred at the design stage. And this is what life cycle basically does, okay? Yeah. So we're able to sit down, trace and see what are some of the costs that I plan to incur across the entire product life cycle. And then you you also look at the revenues, okay, that will also be able to be gotten, and then you're able to also even predetermine the profitability, okay, of the product, okay. Yeah, so that is what life cycle does. Features of life cycle, or what you may call X-sticks of life cycle. As you can see, it considers planning and design costs. It's also prior, just like the way we did our target costing. Life cycle costing is also at the planning and the design stage, okay? So it considers the planning and the design costs as well, okay? It also intends to have a product designed several times, okay? As a way of making the life cycle longer and longer, like I've talked about the rebranding, okay? Why we brought in the Nokia industry here is, of course, because they failed to move from these button phones to the smartphones very faster. So any good life cycle costing system should be able to incorporate all the aspects, including the reinvention stage, okay? So if somebody who came up with a product of mobile money should not just think that this product will exist forever, okay? Should be able to reinvent this and say, at one point in time, we shall actually have a bank, the MTN bank, okay? So instead of just having different kind of maybe service centers or different mobile money points, we shall actually have an MTN bank that is able to incorporate all this that we are doing, okay? So that's very important when it comes to life cycle costing. The other feature is that a product is sold at a very high price at the inception, which is called the market skimming, okay? I think remember about pricing, where we said we have the premium pricing and then the penetration pricing methodology, okay? So when it comes to life cycle costing, because at the start of the life cycle, we have incurred nearly, let's say, a little higher costs, but this product is still fresh in the market, okay? And why we also adopt the market skimming is at this time, the introduction stage, we actually have less competition, okay? We have few people that are actually competing with us, okay? And then the other feature is that practices committing costs are heavy at the beginning of the product life, because we assume that the product is later manufactured, it becomes impossible to redesign it, okay? Because the customer has already gotten used to the product, so might have challenges around there. So we're able to commit most costs at the start of the product. So we do all it takes to make sure that the product is rightly. So we just have what somebody would call the life cycle costs. When somebody says life cycle costing and speaks of life cycle costs, you should also know what they mean by the costs. As you can see, life cycle costing, we are looking at the research and the development costs, okay? We are looking at the production costs. Now you can see the life cycle costing, look at it from the perspective of the different stages, okay? Ask yourself at introduction, what actually takes place? At growth, what takes place? At this other stage of maturity, what takes place, and so on. So these are the respective costs, as you can see: marketing, distribution, inventory costs, retirement costs, and so on, okay? So down here, we just give you the different life cycle, just so you understand it, okay? How it moves, like I've given you, starts from development, introduction. For introduction, we have growth, maturity, then decline, okay? So we're able to understand how each of the stage is also very important, okay? And then the other is understanding what is your role as a management accountant. Now, we know very well that as we study MDC, we are studying this paper as management accountants. So it's good for us to understand, as management accountants, what are we exactly doing, okay? So one of the things that we are doing as management accountants is to determine which designs minimize the assembly and service times, okay? And hence costs. Remember, your role as a management accountant is also to support the organization to cut costs as much as possible. Then we're also able to evaluate the impact of different design possibilities on the cost of developing, producing, and owning and operating the product, okay? And so on. And remember, this is at the design stage. So that's why you know that if you're a management accountant, you're not only going to wait for the time when people have started selling the product. You should be part of this whole process, okay? And provide the decision makers with the respective cost estimates that can help them make the respective decisions, okay? Yeah. So as you can see, you also an intermediary between the design team and the senior management, okay? Being able to give management different analysis of why we should choose this product component over this other, okay? Like that. Then we have, of course, the benefits of life cycle costing. We are saying the visibility of all costs is increased, okay? Because we're able to look at the overall product life cycle. We're also able to look at the individual profitability of each product, because we're not just looking at the product for a very shorter time, but we are looking at it for the overall time until its decline, okay? Yeah. So as you can see, also just looking at the how to maximize return over the product life cycle, okay? Design costs out of the product, okay? Basically carefully designing our product and making sure that we are not adding any components that are not useful and so on. Minimizing the time to the market, okay? Making sure that the time between development and introduction is not that huge. Minimizing the break-even time. Break-even means the time between our total revenues will match with our total costs, okay? Also minimizing the length of the lifespan of the product in the market, okay? And so on. So this is just about service and project life cycles, just also to rethink and see, do services also go through the same, just like the way products go to, okay? So good for you to take some good read of this information and you'll be able to appreciate, okay? So that's very important for you when it comes to life cycle costing, okay? The notes will be able to give you more insights, okay? They are really very detailed for that purpose, okay? Yeah. So the other we want to comment about is the activity-based management. The activity-based management, this one is a model that develops from the ABC, okay? The activity-based costing. We must have commented about this at one point in time, but just to recap a little more information here, okay? As you can see, we have the operations ABM, okay? Activity-based budgeting, activity-based management. Of course, activity-based budgeting is also very similar to this, but activity-based management is basically a method of identifying and evaluating activities. The keyword here is activities. Remember, activity-based costing is activity focused. Even this is also looks at more of activities. So identifying and evaluating activities that a business performs, okay, using activity-based costing to carry out the value chain analysis and the re-engineering initiative. For now, we now know what the value chain analysis and the re-engineering involves, okay? So with the ABC, ABM, we are saying that we are taking the activity approach, okay? In making sure that we are doing our value chain analysis as well as the re-engineering initiative, okay? Yeah. So ABM, it can either be operational, okay, or strategic, okay? And by being operational, in simple terms means that we are doing things right. Operation is about doing things right. Remember, you are a day-to-day running of the operations. Basically, we use the ABC information to improve the efficiency, okay? And here means that any activities, okay, that add value are identified and improved. Activities that don't add value, of course, are either eliminated or reduced so that we can reduce the cost, okay? And then of course, that is the day-to-day operation. Now we have the strategic ABM, which is forward-looking and looking at the external side of things. And this, we call it the doing the right thing. Okay, these two things are different. Operation ABM is doing things right. It's the operational. Okay, strategic ABM is about doing the right thing. It's basically giving guidance. Okay, and here we are saying that we are using the ABC information to decide which products to develop, okay, and which activities to use. Okay, so that is the principle when it comes to this operation ABM and strategic ABM. Okay, so you'll be able to read more information about there. We have to implement, for us to implement the ABM system, we have these steps to follow. The step to follow is identifying the major activities that take place in the organization. And then the other is to assign costs to the cost pool. Remember what we did when it came to ABC? Still, ABC also involved identifying activities, okay? And we're able to assign these to respective cost pools, okay? Cost pools, like they are like key headings for the costs, okay? And then we go ahead to determine the cost driver, just the same thing that we have the other side, okay? Yeah, like that. So we also have benefits here that you can look at of ABM, very similar to the the benefits of ABC. One of those that come in here, of course, improves efficiency and effectiveness. Remember, during ABM, you're looking at activities that are value adding and adding more money onto them or improving them. Activities that are low adding or they're not adding any value, you actually dealing away with them. Okay, so you're basically improving your efficiency and effectiveness. The other is of course, eliminating any value added activities, which means that you're reducing on your costs. Okay. The other is you're improving specific operations by managing activities that cause the measured costs. Okay. You're not just allowing things to drive you by the wind, but you're managing activities to make sure that if an activity is not needed, it should actually be eliminated. And at the end of the day, that will help you improve the customer satisfaction, mainly the product that you give to your customers, and increase your profitability, because you're going to price. Remember, with ABC, we price our products rightly, and it means that we're able to attain the desired profitability. Okay, yeah. So the other that I want to comment about lastly, okay, is the environmental cost management. It's also a key component of our strategic cost management systems, and this is of the fact that organizations are taking more emphasis on environment. Okay, and this is around environmental protection. Okay, making sure that there is less pollution, but also things like maybe being able to waste management, being able to cater for the wastes appropriately. Okay, so that is very important. So now, whatever we do with the environment, whatever efforts we put to the environment, especially as a business, because this could either be to meet the legal perspective of meeting the regulatory requirements, for example, from NEMA for Uganda perspective. This could also be around the customers. Our customers, once they see us more focused on improving the environment, okay, means that they will trust us more. They will not just think that we've come to take as much as we can take from the environment, destroy the environment, and just leave. Okay, so all that comes with a cost. Okay, so as management accountants, we should also take into consideration to make sure that we are accounting for any of these costs, okay, and monitoring them and making sure that we are even looking at a cost report. So an environmental cost report is, of course, produced periodically, okay, and this indicates aspects to do with prevention, detection, internal and external failure costs. We looked at this when it came to to the quality costs, okay? But also these are also common when it comes to the environmental costs, okay? So once we draw that, once we prepare that report, then management is able to make decisions coming from those respective categories, okay? Yeah. Of course, benefits that might arise from us using this system: increased awareness, okay, about the environment and how it affects our financial statement, okay? Organizations that adopt this system are more likely to take advantage of cost reduction, okay, because they are more focused on not wasting a lot, okay? And they also go ahead to do things of recycling, okay? This is where aspects of recycling may also come in as well, okay? And then also it may help to provide us more accurate product costs, because you're not just on looking at the normal product costs, but even going ahead to look at what are some of the costs that might come in from us maintaining the environment, okay? So that is very key for you to, so you're able to cost your products rightly, okay? And then also managing the risk when it comes to environment, because you may never know what may exactly happen with the environment, okay? So that is something that we need to basically take in place when it comes to environment. So those are the different categories, like we earlier indicated, very similar to what we had when it came to the quality costs. So you'll be able to read those, and you're able to read now what the management accountant plays here, okay? Remember, we are the ones that record these costs, okay? And our recording of these costs would include things like planning, okay? And including these new costs and capital expenditure, things like investment appraisals. And investment appraisals should not only look at the on the general costs and benefits, but should also touch on what is the impact of such an investment on our environment and what are some of the costs that we might incur, okay? If you're dealing in a mining and oil company, you definitely realize that it does not end about just extracting the oil, okay? But there are also processes that are supposed to be done to bring back maybe the environment to what they found it to be, okay? Yeah, so all those need to be incorporated when it comes to our environmental costing, okay? So on and on that you can read more about environmental costing. We also have this outsourcing. I already commented on outsourcing, okay? Outsourcing is where you decide to get part of your functions from an outsider, okay? We have different reasons why we've taken this angle. Of course, organizations are looking towards what we call a lean management structure or a lean structure. They don't want to have bigger functions. And I think, especially in this era where we have a lot of startups coming in place, we have a lot of lean structures taking lead here. Organizations just want to have a single office and outsource everything, outsource accounting, outsource marketing, and so on, because the costs are high. And also knowing that with the dynamics currently, you find that the costs are high. For me, instead of having an accounting department, I rather hire an accounting services firm that I'll pay, let's say, maybe 1.2 or 2 million per month, instead of having a finance manager, an accountant, an accounts assistant, and so on, okay? So basically, the trend is coming in because of increasing cost structures, the increased globalization, the increased changes in the markets, and so on, okay? Increased priorities for the organizations, and so on, that you can think about, okay? Yeah. So performance of outsourcers, you also need to make sure that you're monitoring the people that you've outsourced from, because you don't want your quality to be affected. Remember, outsourcing also has its limitations, because you might also outsource some services and you may have an implication on your quality. Remember, if you're doing it internally, you have a control over your quality. But if you're outsourcing it, then you have some a little of laxity on the management who is actually serving you. You might also have things like your trade secrets being affected during this process. So you basically need to have all these insights, okay? So we have non-financial considerations, and these are the non-financial considerations that I've just spoken about. where you have to look at the quality of what you're getting from the other person who is being outsourced, any risks around maybe trade secrets. You also need to look at things like, will this create a spare capacity? Okay, sometimes you're outsourcing, but you're going to have a spare capacity. Maybe you're going to have some redundancy in one machine. Okay, so you need to look at all those factors. Okay, so all this information will really be very helpful to you. Of course, advantages, as you can know, you reduce costs. Okay, you're able to concentrate on what is priority to you as an organization. You're also able to be more competitive, and then you're also able to get something of much quality. Instead of bringing it inside as an organization, there's somebody who can do it much better, so, and also do it at a cheaper cost. Okay, yeah. And then of course, disadvantages, like I said, you lose your trade secrets. You don't have much control over what the other person is bringing in. Okay, and that may also affect your final product. Okay, and it is costly as well. It may also be costly in the long-term run. Okay, and so on. So you can be able to read all this information, and it can be helpful to you. Okay, yeah. And then the value chain analysis, we already talked about the value chain analysis when we are looking at the target costing, though the other one was value analysis, but same principle. Okay, and with value chain analysis, it's basically also, from the word value chain analysis, you're basically looking at the different activities. Remember, production, distribution, that whole process, like the overall organization is like a value chain in its own. Okay, so we have primary activities, which are to do with bringing in, for example, these are they concerned with creating and delivering products. Okay, and then supporting activities, like let's say support functions. Okay, as well. And then maybe you could get it from this table here. Okay, so primary activities, these are like operations, inbound logistics, outbound logistics, marketing and sales. And then we have the support activities, which you come in finance, HR, and so on, procurement, and so on. So by value chain analysis, what we are basically doing is we are trying to look at our overall process. Okay, we're trying to look at our overall process to see how can we let's say become more competitive as a business. Okay, so we are basically measuring ourselves also with the competition. Okay, and that's why Michael Porter suggested those two elements of the value chain, the primary and the support activity. So you're able to analyze those and able to know where you lie as a business and see how you can basically improve that. Okay, so I would love to end this class here. Okay, I believe you have these notes, so you can basically try to go through. I know there are really many, but there are many pages, but make sure that as you go through this, you benchmark with what? With the syllabus. Okay, what is on the syllabus that we didn't talk about here was the balance scorecard, but I remember we did the balance scorecard when we were looking at performance measurement. Okay, so reference it from that perspective. Okay, yeah, balance scorecard is also a common concept that the examiner is interested in, so make sure that you're trying to understanding it from the other perspective. At least I said more information about it. Okay, and the key principle with the balance scorecard is it looks at both the financial and non-financial measures. Okay, yeah, so thanks so much, and wish you all the best in this. Okay, yeah.
Hello.
So yes, please.
Yes, good evening.
Good evening, how are you?
All right, yeah, thanks for today's session. I have a request that is it possible that we have some revision sessions also, because days are approaching, and I wish we could do some, maybe like we run through some past papers, and yeah, so that we can also in case some areas that you're not understanding, yeah, you can support us in them. Yeah.
When is the paper?
It's on Friday.
It's on Friday.
Yeah.
Okay, let's see how the week goes. I hope you're going through some of these things as well.
Yeah, you're doing. Yeah, but I think also revisions will other, because they are like we might be getting some of these notes now, but days are also going. But I think also revisions will work much more. Somehow we could balance them. Yeah.
Okay. Let's see how this goes. Let's see how this
Right.
goes. I think I shared with you. Is there part of the syllabus that you don't have any notes? Do you have any notes that you don't have?
That will let you know. For now, I think I need to confirm. Maybe Tempo.
Yeah, I
I
think
don't know where Tempo is. Tempo has dropped off. But I will need to confirm because you're using them vis-a-vis the SPU study pack. So, but I think we need to confirm. I'll let you know on the group.
okay.
All right.
All right. So thanks so much, everyone, and whoever is watching the replay as well. Thanks so much also for watching in this, and all the best to you. Okay. Have the best in the rest of your time. Thanks. Bye-bye.